The U.S. is heading into recession, and we may be in a recession. Everyone's like, "Wait a second! Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after two pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just, not show up for the game.
In the high-stakes realm of global finance, a subtle yet seismic battle is unfolding, and the destiny of the US dollar as the world's reserve currency is precariously hanging in the balance. Jim Rikards, acclaimed economist and mastermind behind currency wars, issues a chilling warning. Surprisingly, the most significant threat to the US dollar isn't a foreign adversary, but an unexpected nemesis within the US Treasury. Rikards makes a razor-sharp distinction between the US dollar's role as a payment currency and its status as a reserve currency. While several nations, including China, strategically reduced their reliance on the dollar for transactions, a more profound and insidious threat emerges from the very heart of the American economic machinery, the US Treasury. In a bold move, the US Treasury has weaponized the dollar by freezing reserves of central banks globally, including the formidable Central Bank of Russia. Rikards paints a stark picture of nations cautiously assessing the situation, pondering the perilous question: what if the US Treasury decides to wield the dollar as a financial weapon against policies they find unfavorable? Countries like China, Russia, India, Malaysia, and Saudi Arabia are actively seeking alternatives to the dollar in trade settlements, marking a seismic shift. China and Brazil collaborate to sideline the US dollar in their transactions, while assorted nations collectively agree to reduce reliance on the dollar. The BRICS alliance even contemplates creating an entirely new currency. Rikards emphasizes the nuance between payment currencies and reserve currencies, highlighting the intricate dynamics at play in this unfolding financial landscape.
During the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession.
Highlighting the real threat lying in the latter, Rikards contends that the Treasury's actions are gradually eroding the dollar's status as the world's reserve currency, the metaphorical savings account of nations. This revelation serves as a sobering wake-up call for both investors and policymakers amid the chaotic financial landscape. In the face of a crumbling dollar reserve status, Rikards points to a glimmer of hope: gold. He argues that this age-old precious metal emerges as the only viable alternative as the U.S. Treasury's shadow war unfolds. Gold, with its timeless allure and intrinsic value, stands resilient as the ultimate refuge. Reiterating his earlier warning, Rikards declares that the dollar is under siege from all sides. Concerted efforts by nations seeking substitute payment currencies, combined with the Treasury's clandestine maneuvers, paint a bleak future for the greenback. The question resonating through financial corridors is whether the dollar can weather this perfect storm. Rikards leaves viewers at a crossroads, a critical juncture where choices and consequences intersect. As the world witnesses the silent shadow war waged by the U.S. Treasury, investors are left grappling with uncertainties. The dollar, once an unsaleable titan, now faces a formidable challenge transcending international borders. In conclusion, Jim Rikards' revelations pull back the curtain on a hidden battleground, where the U.S. Treasury's actions emerge as a potent threat to the dollar's reserve currency status. The global financial landscape undergoes a tectonic shift, and investors are left to navigate treacherous waters of uncertainty, seeking refuge in the enduring luster of gold. The stage is set, and the dollar's destiny hangs in the balance.
The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation's not bad, and it'll give you a lot of optionality. You know, you can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons, there's enough wars going on, but defense will do well, and mining, because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So Treasury notes, a 2-year note, a 5-year note, will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today.
And that's it for this video. Let us know your thoughts in the comments down below. Thanks for watching till the end. Before you go, make sure to like and subscribe, and click the notification bell to trigger YouTube's algorithm and see more of our videos on your homepage. Thanks for watching, and see you next time for more interesting videos like this.